As part of its climate change policy, the Rudd government has committed to the introduction of an emissions trading scheme in 2010, and this will have major implications for us as investors. It would be nice if today we were able to provide the definitive answers on how the emissions trading scheme is going to look. Unfortunately, despite having a highly qualified and knowledgeable speaker, it's not going to be as simple as that. Although the scheme is scheduled to be up and running as soon as 18 months away, the government is still in the research and development phase of the process, so the detail of the scheme design has not yet been finalised. Nevertheless, our speaker today will outline what is known and take us through the possible scenarios of scheme design and talk about the implications of them. And she's eminently qualified to do so. Dr. Lorraine Stephenson is the National Leader Climate Change for Deloitte Inside Economics. In this role, she provides policy, strategy and economic modelling advice to a range of Deloitte's clients. Her specific areas of interest are working with clients to develop strategies to mitigate risk and capitalise on opportunities arising from climate change policy, including emissions trading, providing scenario analysis to better understand future emission projections and options to incorporate innovative solutions including low greenhouse gas emissions technologies, and developing carbon footprints and marginal cost of abatement curves and opportunities to participate in offset markets. Lorraine is a member of the New South Wales Premier's Greenhouse Advisory Panel and represented Deloitte at the National Climate Change Summit in 2008. She's also active in the international debates on this subject. Please join me in welcoming Lorraine.
As Louise said, unfortunately, we still don't have a final design on emissions trading. So one of the things I thought I'd do today is give you a fairly quick overview of the status in terms of understanding where the Australian government is, understanding the implications of the Bali roadmap, and looking at what industry has to do to prepare for the introduction of emissions trading in 2010. So we just look at the context for a minute in terms of why is Australia looking at emissions trading. The world, as far as Australia goes, has changed quite a lot. For anyone else who was at Bali, it was a very, very different international meeting this year, or in 2007. It was the first time, of course, Australia had actually committed to the ratification of the Kyoto Protocol, and that has now taken effect as of last week. So one thing is we haven't even made a decision yet as to whether Australia will participate under the protocol for the emissions trading scheme from 2010 to 2012, which is the first phase of the Kyoto Protocol. So it's a very big issue that hasn't been resolved. The other thing is, of course, that in 2008 we're sitting here now and Kyoto has started. So that in itself is just a very different mindset for people looking at these issues. It means that the carbon market's very much driven now by the regulation that's in place. And in fact, once you start to have these sorts of carbon markets building, and last year it was $60 billion of known trades, and it's growing exponentially, that there's a lot of financial force behind these continuing. The other thing is, of course, that we do now have a Bali roadmap. We have a 2-year program to get to Copenhagen in 2009 to decide on what those targets will be for post-2012. So that's absolutely critical in Australia itself, setting its targets, we hope, out to 2020. The other thing is, of course, we do have the competing drivers. So where everyone in the developed world has the luxury to think about what we might do to reduce our greenhouse gas emissions, I'm sure most of you are aware that in the developing world, that's a luxury that most people don't have. They're much more interested in actually having an improvement to their standard of living and having some sort of energy security, in fact, having any energy supply. And the other thing is, of course, it's a very commercial issue. So we will actually talk about that as we go through. And for investors in the room, it's important that you understand the implications. So if we quickly look at what were the Bali implications for Australia, then what it means is between now and December 2009, we have to be able to work out what we can commit to for the longer term, particularly at least the 5 years after 2012, and be part of that international negotiation. There's a whole series of meetings that have been set up, but the analysis has to be done at home to determine how we can contribute to that forward target. As I said, it's a 2-year process. There will be an interim meeting in Poland in December this year, and then the meeting in Copenhagen will be a very vital meeting. And if we haven't decided by then what happens after 2012, you can understand that some of the financial markets that have been built up on the regulations under Kyoto will in fact be in jeopardy. So the other thing is in terms of what does it actually mean for the technologies coming forward too. It's very difficult to commit to investment if in fact you don't know what the future regime is. And the carbon markets are incredibly unusual in the sense that they are driven by regulation. It's not the same as a pork belly market where you've actually got a commodity that you produce at the end of the term of the contract. In this case, it's largely driven by regulation, and as those regulations change, the value of the commodity will also change. As I said, the other thing is that the Australian government hasn't had to deal with the issues that arise from ratification previously. And so with the new Labor government, they're still working through as to whether Australia's regulations in the period to 2012 will in fact be domestically designed or whether they'll fall under the Kyoto Protocol regime. There's a number of mechanisms that become available to Australia following ratification, and these are called the Clean Development Mechanism, the CDM. There's a lot of acronyms, I have to tell you, in climate change work. There's the joint implementation, and they differ in the CDM is where a developed country invests in a developing, and joint implementation is developed country into another developed country. And the other thing is, of course, the international emissions trading. And for all of these to work, you need to have certain regulatory infrastructure in place. So, for example, you have to have a national registry, which we don't have at the moment. It usually takes a minimum of 18 months for this to be signed off by the UNFCCC, which is the UN body that oversees climate change work. So there's a lot of work that has to be done to get the necessary infrastructure in place. We can't just decide today that we're going to participate internationally just because we've ratified. And the other thing is that under Kyoto, you have units that are defined by the target. So Australia has 108% on 1990. That converts to X millions of tonnes, it's about 500 odd million, and then you get AAUs, which are the assigned amount units, and they're like a gold-plated commodity that gets traded internationally. We haven't decided yet in Australia in our emissions trading scheme whether in fact our units will be equivalent to AAUs or not. And for example, New Zealand's going through the same issue in thinking about linking with Australia. So one of the things that I think an important message I want to leave you with, which we'll come back to, is that even though this presentation is about emissions trading, if you're thinking about it from the fund manager's perspective in particular, the carbon price is not the only thing you need to look at. There's a range of different changes that we'll see in industry as a result of a broad sweep of different impacts. So the policy impact, of course, is very important, and it's largely in Australia to be driven by emissions trading, but there's also the physical impact on different assets, and of course there's a reputational exposure as well. And my comment at the bottom, which I'll come back to, is there's no doubt there are winners and losers, and we just have to accept that. So I won't go into detail with the slide, and the slides will be made available, I'm sure, but there are a number of examples. So for example, the regulation, as we talked about emissions trading, we'll focus on that. But there's also the development of new technology, and how quickly will that become available at scale and at low cost, and also just looking at how the markets will develop, what the physical operations will look like with true climate change impacts, and also the volume in terms of the changes that we're looking at in abatement, for example. So one of the things that I do with clients is I can't predict the future. We don't know the rules. We don't have international rules. We don't have Australian rules, except for the Kyoto period internationally. So one of the things and as I said, the market is only driven by regulation and can change quite quickly. And so one of the things that I do with clients is just simply build scenarios going forward, and it gives you some idea then of the range of pricing that you could look at. This is not prescriptive, but just to give you some idea. And you can think about the sorts of issues that we're dealing with every day now. So if you look at the financial markets and the subprime issues, many developed countries are more focused on those issues today than deciding what they're going to do about greenhouse gas emissions. So all of a sudden the public opinion can swing. And in that case, you do actually have the regulations, but you probably have a much lower price. And of course, the expected scenario there is about $30 US, and this is over the period 2008 to 12. Or if you think a much more aggressive scenario, and this is probably a case where energy demand is driven dramatically, or we're actually seeing something that drives opinion to say that climate change is more real and we have to do something about it faster, and therefore the price would go up quite significantly. So you can imagine how difficult it is for business to be planning under a regime where the pricing could be of the order of $15 or it could be $100, and that's in 5 years. So in Australia, just one quick slide to say that we do have mandatory greenhouse gas reporting, and it starts on the 1st of July this year. It captures about 800 odd companies, so it's quite extensive. We'll only have 1 year of data before the emissions trading scheme starts, but that data will be quite helpful in terms of the market understanding the bottom-up measurement of emissions versus the usual top-down. In terms of what we saw with the Rudd government coming in on its election promises, they have actually obviously done a number of things. They've ratified the protocol, they've established the Office of Climate Change at the new department, they've articulated again the aspirational goal out to 2050, and again continue to articulate the legislation for an increased MRET will be introduced next year. A number of other activities are still on the drawing books, but they're being worked on. In terms of this presentation, as Louise said, one of the things is that the Rudd government, though, hasn't actually articulated any detailed design elements of the emissions trading scheme. So what we've had in the past is we had the states process, the National Emissions Trading Task Force, for what they called the NETS, the National Emissions Trading Scheme. That was about 3 to 5 years' work and only really concluded in December. Most industry who were involved in this, energy producers and energy users, were quite involved with the states process. It was every state and territory in Australia. We had that, and we had a significant number of recommendations, I should say, in terms of how a national scheme should be designed, but it didn't have the Australian government involved. And then in December 2006, we had Prime Minister Howard appoint a task group to look at emissions trading, and they reported back in May last year. That's the most definitive piece of work we have, and it did actually build on the state's work. And where we're at now is we separately have Ross Garnaut's climate change review, and he's working independently from the government to make further recommendations. So we have a number of processes that have happened, and industry is continuing to make submissions, working with both the Department of Climate Change and the Garnaut team in terms of how we might see an Australian trading scheme, and also think about the issues of ratification. So very briefly, it is a cap and trade scheme, which means there's a limit on the number of emissions, and the price is therefore driven by the market. The previous government was looking at 2011, but the new government at 2010. If we think about the principles, as said, and this was pre-election, the government has since articulated, and the new minister, Penny Wong, has confirmed that they're looking to be economically responsible. So Treasury is doing a significant amount of work on the modelling for the Australian economy and what it will mean for individual companies. Very much looking at a complementation of an increase in MRET, the mandated renewable energy target. It's good that government thinks the scheme should be fair, but of course that's very hard to test. And the other thing is, of course, we need to start now, and you can't criticise the government. They're certainly working very quickly. So as we said, no detail yet, but there are some considerations that you might think an Australian Labor government would look at differently to the previous government. And so thinking about, and of course, the other issue is the ratification. So some consideration about how we'll link internationally. We could do that faster now that we've ratified compared to the previous view. The targets, for example, do we want to be harder, more stringent on the targets than perhaps the previous government suggested? Some issues about how the permits are going to be allocated is certainly up for grabs. And also, if there is revenue to be gained from an auction, then how will that be recycled? The issue, though, is any government has to sell this to industry and to its other stakeholders, including the community, and so it is still a significant amount of work to go forward. So these couple of charts are taken from the task group report. So that's the previous Prime Minister's team that worked on this and produced a report in May last year. And what they're considering is setting a cap that is probably out to 2020, that's firm, so a yearly cap on emissions out to 2020, and then some sort of a gateway that follows that. So it's a sense of where the target might be after that period, but not a full confirmation. and this is aiming at getting to some sort of aspirational goal by 2050. So this slide shows that initially there's a view that there would be some permits that would be given out for free, and that still has to be debated. There's a small amount there in the yellow, which is for the trade exposed sector, because Australia still is competing against countries that don't have a carbon regime, and so there's a view that at least for 5 years, some of these countries that are trade exposed, as in export and import competing, would actually get a free allocation. There's a certain quantum, but a small one initially for auctioning, and then there's a view that there may be some permits that are retained in terms of the overall national cap. That's very illustrative only of thinking from last year, and we don't know, in fact, what that will look like once the scheme is fully designed at the end of this year. So when we think about emissions trading, the most contentious issue in Australia is the initial allocation. And industry certainly has a lot of views about this, and there's a lot of competition for those permits. But the pie is as big as the pie is, and you can't make it any bigger, and we want to actually reduce emissions. So everyone is really competing against each other in terms of either an initial free allocation or in fact the quantum of permits that would be available at auction. So the concept from last year was that the trade exposed industries would in fact get some free allocation for at least a 5-year period, but only for that trade exposed sector, not for any domestic sales. And there was a view that anyone that could prove that they were disproportionately impacted, so effectively that came down to the coal-fired generators, they would actually get some free permits for transitionary arrangements. It's certainly not enough for their needs, so they would also have to go to the auction. And there were no free permits to be made available to new generators, but there was a proposal that would be new free permits to new trade-exposed investors. And the other thing that in Australia, a large part of this has to be the auction. And from my own perspective, talking with clients and talking with government, is the one area that's got very little airplay at all. There's no example in the world where there's been greater than a 5% auction for environmental commodities. And we expect that in Australia that would be significantly higher. So there's no precedent anywhere in how this auction will be carried out. I won't go through that one. And so in terms of auctions, it's certainly a lesson that we have to learn. In northeast US, there are some auctions coming up under what's called the Regional Greenhouse Gas Initiative, RGGI, in the 10 northeast states. New York looks like going to auction in about July because their scheme starts in January next year. But to date, there's no precedence whatsoever. One of the most important issues, if you think about it from a business perspective, is simply how frequent would these auctions be? How many permits would they want to buy at any particular point in time? And how expensive would the settlement costs be? So does everyone go along on a particular day with a very big cheque and hand it over to the government because they simply want to buy a few million permits? You can imagine if permits are $20 or $30 a tonne and you need to buy a few million, then we're talking about quite a lot of money here. And there is absolutely no view that's been articulated as to how this will be managed. The other important issue, I think, in the scheme design is offsets, and it doesn't get too much of a mention, but you will know that the conference is offset today, so somebody is actually going out and doing something worthwhile to reduce emissions or to capture CO2 in terms of forestry to offset any emissions that could occur during the course of this meeting. In the same way as the government has proposed that there would be an opportunity for offsets within the market, and so what they call the non-covered sectors, and at this stage that's agriculture and forestry, they could in fact create credits in Australia. It would be very regulated in terms of what the methodologies would be. You'd have to prove that a tonne is a tonne. There's some sort of equivalence there the market could accept, but as long as those methodologies are approved, then in fact the market can create offsets and forestry or agriculture could sell them. In the same way as there's international units, and we saw before that there's the clean development mechanism where you invest in a developing country, or JI where you can in fact invest in a developed country, for example, Russia or the Ukraine are actively promoting those sorts of projects. But we haven't really had a debate in Australia about whether these permits, these credits from the offset project should be allowed uncapped into an Australian emissions trading scheme. Nor have we in fact determined after ratification whether in fact Australia will itself participate as a JI country. we do have the potential to create the sort of projects. There is investment from Japan and other areas looking to create the opportunities here in Australia. But what it means is that, let's say Japan was the investing country, they in fact take the emission reduction units out of Australia. So in fact you export them, which makes our task of reaching any particular target even harder. There's been no view from the government to date as to whether they'll allow that, and if they do allow it, whether they'll cap it, and we can't actually just start those projects because we don't have any registry or other infrastructure in place at the moment. So just a couple of quick graphs to illustrate. I'm not talking about something that's particularly new or emerging here, in the sense that as of March last week, there was 127 million tonnes that have already been issued as certified emission reduction units from the UN FCCC. We're talking about a very vibrant market internationally, and it's a shame that in Australia we're just so remote from the mechanisms of this market that we don't see it day to day, and it feels like something new and different and difficult to deal with. But already investors have got 127 million CERs that have been issued. There's 1.2 billion in the pipeline. It's a very active market. And if you look at the breakdown, the projection through to 2012, the end of the Kyoto period, is that half of these will come from China. A very significant proportion also from India and other Asian countries. So Australia is very well placed to capitalise on these carbon markets. One of the things that, as I said, it's a market that's driven by regulation, and part of that regulation is where is the demand going to come from. So one of the things, just a quick slide to show you that the US is actually doing a lot. It's very much like Australia. It was driven by the states. They still don't have federal legislation, of course, but they have about 20 bills that have gone forward in the House proposing emissions trading, and all of the key proponents for the next election are suggesting they'll have emissions trading. So you can see that on a state basis there are a lot of schemes going forward, and each of these will in turn create demand for CERs, which means in theory the price should continue to rise. And in Australia and New Zealand, of course, for us to meet our target, we assume that there'll have to be demand coming from our countries. New Zealand is so short on its target that it's relying on international units to meet its Kyoto commitment. And again, we have to answer that question because investors would like to make these investments today. They could actually hold their CERs on the UK registry, for example. They're not adverse to allowing someone to use it. And you could play a game of arbitrage for a couple of years if you wanted to, or equally you could just simply allow those units to sit there and wait and bank them for your liability going forward in Australia. But we haven't got advice yet as to the full criteria around using CERs in Australia. The other thing that's important under an emissions trading scheme is what the penalty will be. So although companies will be motivated to take action, they're obviously more motivated if they understand there's a penalty. And there's still a debate now as to whether that penalty should be relatively low, simply above the marginal cost of abatement, or the alternative would be that it's very high. So if you consider in the EU today, it's €100 per tonne. Now, I could find so many different projects around the world that are significantly less than that, so you have to wonder why anyone would pay it. But the EU's view is you make it so bloody high that of course everyone complies. And in the EU, it's not just a matter of paying the penalty, you also have to make up the difference. So it's an unlimited penalty, if you like, which New Zealand also has, and Australia's debating whether we want that sort of setup or not. The other consideration that comes forward with emissions trading is we probably don't want to do this on our own, that it's much better and more efficient, in theory, to link with international markets, but there are downsides as well. To some extent, you lose your sovereign rights over the design of the scheme, because as soon as you start to link with another scheme, you almost import their rules, and equity starts to flow towards, or you create an arbitrage situation where there's a movement for compliance towards the least cost penalty market. So there are some issues there, and the most likely initial linking is through the Kyoto mechanisms of the clean development mechanism. It's like an international go-between in terms of the EU is allowing CERs, we're likely to, New Zealand does, but none of us are actually looking to directly link in the near future. So the other thing is that how are we going to resolve that going forward? So that's a very important issue which is more relevant today because we have ratified. The other proposal under the previous government was that to encourage abatement between now and when they proposed the scheme in 2011 is that they would encourage business to look for early abatement, and they would get credit for that essentially in a voluntary market, or there was some view that that would carry over into the mandatory market. We haven't got any word yet as to whether the government wants to do that. It's less likely with a 2010 start, but you could still create abatement today and have it accredited under the Greenhouse Friendly program run by the Australian government, and actually sell that into the voluntary market. So not only do you reduce your forward liability because you simply have less emissions going forward, but you can also monetise those reductions today. So one of the things is to think about, well, what are these implications of an Australian emissions trading scheme on industry? It's important to think about what a carbon price does. It makes decision makers focus on their energy intensity. They have to look at whether there's an alternative, for example. They have to understand their energy life cycles. And part of it is really looking at how they can be innovative and profitable going forward, but actually break that nexus between production and energy intensity. So one of the things is just to simply look at what it costs you in your own business to reduce your emissions, or alternatively to go to the market to buy, whether that be in Australia, whether it to go to an auction for our permits, or whether it to go to the international market. The thing is that one of the observations I'll make working with Australian industry today is that most companies aren't ready for this, and they really haven't worked out that set of options in terms of whether they should buy or whether they should reduce themselves. So in thinking about it, the first group of companies that is the most exposed, I think, are the power generators. And when you consider Australia is very reliant on fossil fuels, particularly with brown coal and black coal, and to much lesser extent gas in Australia, all of these power generators will be affected by emissions trading. To a large extent, it will depend on, in terms of their own profitability, it will depend on the initial allocation of permits. The market itself and the carbon price will not be impacted by that design, but their own profitability will. If they simply are given a certain proportion for free, then that increases their profitability. So you can imagine the brown coal generators that are the most intensive in terms of greenhouse emissions are quite worried about what these rules will be, and are doing a lot of work to understand, as we talked about before, in the terms of the scenarios going forward. So the coal technologies are also looking at what their alternatives will be, because Australia has several hundred years worth of coal. So the issue is, can we continue to use that coal but not have the same greenhouse intensity? And therefore the CO2 has to be captured and has to be stored through things like carbon capture and storage. Those technologies are quite expensive, and so one of the things is that people are looking at what the forward carbon cost curve will be to understand whether they'll ever get a payback on those sort of technologies and what the incentives might be up front. The other thing is, of course, there are upsides. What you're seeing is a lot of coal-fired generators are starting to diversify their asset base. They're looking at more gas, they're looking at more renewables, they're doing a lot of investment in the clean coal technologies and some of the emerging renewable technologies. The other thing is that no matter what the technology you're looking at, water often plays a major role. It certainly does in the very large power stations, and it's not hard to understand that that's a risk going forward as well. So we need to be innovative, not only in terms of greenhouse gas emissions, but also in the use of water. The other thing is just the physical impacts. So the power sector is also, of course, subject to the physical impacts of climate change, looking at what it means for their own assets, but also the demand that comes from the public. So when you look at Adelaide last week with at least 10 days over 35 degrees, it'd be interesting to have a look at what the load curves look like for the power supply into that state. The other thing is, of course, looking at the resources sector. So a lot of these are trade exposed, and they're looking to compete against countries that don't have any particular carbon constraint at the moment. So in the near term, the outlook here is very, very strong. If you're looking at coal or iron ore or other exports, other mineral exports, then it's all looking very good. The thing is, though, that some of these industries also need to think about the clean coal technologies. So what we're seeing is some of the coal miners who have no power assets whatsoever are investing in clean coal technologies simply so that their asset can continue to grow and that they have something in turn to sell to their customer bases. The other particular winner, of course, is gas, and particularly LNG, which is in a form that's exportable. And so gas usually, compared to black coal, for example, has half the greenhouse gas emissions in power gen and 1/3 of brown coal. So LNG is very, very attractive to international markets as well as Australia. No doubt you all know that uranium's looking pretty good as well. If you own any uranium shares, they've done very well. But there are some obvious risks in that sort of market as well. My previous involvement in Origin, we did a lot of work with geodynamics and the hot dry rocks in the Cooper Basin. It looks very prospective. It's one of the few renewable technologies that in fact would allow for baseload generation, but there's still a lot of work to go on there. And it's typically in places where people don't live, and so therefore you have a high cost of transmission lines. Just thinking about other implications, for example, an industry like tourism, what is it going to mean there? Definitely have higher fuel costs, whether it be for airline travel or whether it be for road transport or whether it be for marine diesel, for example. But also you do have the climate impacts as well that compound the risks to the industry. And also, if you are looking at higher costs for energy and for basic commodities in Australia, then what happens to the disposable income for Australians travelling, and also just the pristine nature of some of our World Heritage sites could, of course, be disadvantaged if they are impacted unduly by climate change. And of course, water is a consistent theme, that we don't have enough water, and so therefore some of our natural attributes will change over time. The manufacturing industries are largely an energy user. They won't necessarily be a direct liable party under emissions trading, but they will see the impacts of a higher cost. And so for them, it's about how they can be more efficient, how they can reduce their energy load, how they can look for alternatives in terms of both the design of their manufacturing, but also their sources of energy. And of course, always the services sector tends to be one that does well out of these sorts of changes, whether you're a lawyer or somebody like myself or many of you in the room. This is a big area of change, and change management requires a lot of consultants and a lot of new designs, for example. So if you think about one very specific issue that I deal with, I'm talking to clients that have measured greenhouse gas emissions for some time. They traditionally, though, measure them in a spreadsheet on a rather ad hoc basis, maybe once a year. And now all of a sudden that has to become part of their mainstream financial accounting. So all of a sudden you're looking at all of those Australian companies having to redesign their financial accounting systems. And I'm not an accountant, but I'm sure someone can actually make some money out of that.